Let's be honest, accounting gets a pretty bad rap, right? For most of us, the word alone conjures up absolute dread. Tax season and stereotypical number crunchers buried in endless, boring spreadsheets. But today, we're completely flipping that script. Welcome to The Explainer. We're going to transform accounting from a tedious, backward-looking chore into a dynamic, absolutely crucial toolkit for business survival. We're shifting our view from staring at the rearview mirror straight out through the windshield. Let's dive in.
So, first things first, who is accounting actually for? If your mind immediately jumps to the IRS, or maybe a room full of Wall Street investors meticulously scrutinizing a balance sheet, well, you definitely aren't alone. That's what most people think. But relying on that assumption actually hides the true superpower of this entire discipline.
You see, at its core, accounting is not a punishment. It's simply a communication tool. Officially, it's defined as a part of an enterprise's information system, providing data to people who have an interest in the organization. And sure, while it definitely feeds those external watchdogs and regulators, its most crucial audience is internal. We're talking about the managers who are actually running the day-to-day operations. It is literally the lifeblood of information for anyone who needs to know what's really going on behind the scenes.
Now, think of the accounting universe as a tale of completely different worlds. Under the main umbrella, we've got three distinct branches: financial, cost, and management accounting. They're like cousins, closely related but serving completely different masters. To figure out how to actually drive a business forward, we really need to understand the clash between those two outer rings, financial versus management.
Okay, let's compare these two worlds, starting with who's actually looking at the numbers. Financial accounting, that is your public report card. It is designed strictly for the outside world, the investors, the banks, the government. But management accounting, now that is your secret playbook. It's created by management, specifically for management, and honestly, it never leaves the building. Its sole purpose is to give your internal team a competitive edge in running the business. And here's where our main analogy really comes to life. Financial accounting is your rearview mirror. It simply records the history of what already happened, the past successes or, the financial damage. Management accounting, on the other hand, is your windshield. It takes all that past data and asks, okay, based on where we've been, how do we navigate tomorrow, next week, or even next year? It's all about looking forward.
Because it faces the public, financial accounting is incredibly regulated. It's bound by strict company law and rigid double-entry standards, and it's usually finalized just once a year. Management accounting, though, total freedom. It is completely optional and entirely flexible. Let's say you need a highly specific performance report on a struggling department by Tuesday morning. Boom, you got it. There are no strict laws holding you back.
Another huge difference is the type of data they use. Financial accounting shows you the big picture, but only in cold, hard cash. It'll show the whole company's profit or loss, but it won't tell you exactly why a specific product failed. Management accounting gets right down into the weeds. It uses both monetary and qualitative, non-monetary data to pinpoint individual products or specific plants. It's literally the difference between knowing you lost $1 million and knowing exactly which factory line caused that loss and why it happened.
The Institute of Chartered Accountants of India actually sums this up perfectly. They state, management accounting is any form of accounting which enables the business to be conducted more efficiently. That is the gold standard right there. It's not just about ticking boxes for compliance, it's about actionable efficiency. It's strategizing and optimizing absolutely every resource you have at your disposal.
So what's actually inside this manager's toolkit? Well, we've got budgeting and forecasting, standard costing and variance analysis, marginal costing, ratio analysis, and cash flow statements. Sounds like a lot of jargon, I know, but here's the cool twist. Managers don't just pull these numbers out of thin air. They actually take the rigid rear-view data from financial accounting and essentially build a telescope out of it to look ahead.
All right, let's put this into practice and make it real. Imagine you've just stepped onto the floor of a massive manufacturing company. You're the manager. You are in charge of buying raw materials, running heavy machinery, and shipping out finished goods. In this chaotic environment, understanding the granular details isn't just some boring spreadsheet exercise, it is literal survival.
To survive here, we really have to look at the basics through a strategic lens. Take the word cost. We all know a cost is simply an amount paid by the company to obtain something. But out here on the factory floor, every single cost isn't just a basic expense. It is a critical lever. It's a lever you can pull to either bleed money or absolutely maximize your profit. Then we have costing, which is the process of determining the various costs incurred. Think of this as the active tracking of where every single one of those dollars goes. From purchasing raw steel to paying the wages of the assembly line workers,
Costing is exactly how we keep our finger directly on the pulse of the factory's cash flow.
And that brings us to cost accounting. This is the technique helping management set standards and prepare budgets. It's the language we use to translate all that active tracking into real action. It's how we set our budgets, allowing us to accurately forecast our production expenses for the next month or even the whole year. It's the data that basically clears off the windshield so we can clearly see the road ahead.
Let's apply this directly to our factory. We have direct labor, these are the assembly workers physically building the product. And then we have indirect labor, like the security guards at the gate or the cleaners supporting the operation. Now, you might be wondering, why does splitting hairs over this even matter? Well, because knowing the exact difference between those two is exactly how management finds hidden efficiencies. It's how they stop budget bleeds on the floor way before they can destroy a quarter's profits.
We've seen how financial accounting acts like that rearview mirror recording history, while management accounting uses that very history to chart a bold, strategic path forward. It's been quite a journey through this explainer, hasn't it? So as we wrap up, I want to leave you with one final crucial question. Think about your own projects, your own team, or your own business. Are you driving looking out through the windshield, or are you just staring at the rearview mirror?